Hello, everybody. Today is February 13th, 2018, and today's webinar focus is night trading with the market profile and the importance of electronic trade relative to the day time frame opening. And I'll hand it over to you, Jim.
Thank you very much, Jen. Couple of comments before we get underway here. The volatility has really introduced an atmosphere that or an environment we've not been accustomed to for some period of time. I think let's go back almost 2 years from the last spike in volatility, and then after that spike, it traded off. It slowed down, but it took several months before it got as low as it was for so very long. With that, with these changes in the volatility, the markets are getting much more interesting. I find I had to adjust. I mean, years ago, most of you know I'm 77, and years ago I was pretty fast on trading, and I had the button and the pad, and you could hit buy and sell at a moment's notice. You had to make sure the cat didn't walk up on your desk because you didn't know what that cat may buy or sell. And I'd gotten out of that. I have a tendency to be a little error prone from time to time, and so what I was doing is putting in I was writing up the order, checking the order, and then sending it. And sometimes you just don't have time to do that anymore. Today was just an absolutely magnificent example. The market ran up, and it ran back down to a place that looked like a real obvious place. And the buy and the sell happened very quickly. As a matter of fact, I found myself going market on most things. I'm even going market on options, which I always recommended against. But the speed with what you do, and I guess what is inherent in what I'm just saying also is that what I had done for some period of time and what we had done during most of the previous intensives, we were calling we broke it down what we called fast trades and slow trades. And slow trades were kind of what I was doing, that they weren't necessarily overnight trades. They might be, but they weren't of the scalping type and variety. And so I was trying to point out places where the fast trades would be. But now I find myself doing some scalping trades simply because the opportunities are there, and they're pretty intriguing. You got to be fast. But as we come up to the following intensives, we've changed a little bit because of the volatility. We are still looking for a little bit long. When I say longer term trades, I mean maybe some overnight trades. But we're doing considerably more scalping type trades, and I'll show you a couple of things this afternoon and some information. Well, first of all, let's go to what the topic is, and the topic really is night trading. We had this scheduled, but prior to actually conducting, even though it was scheduled, there was an article in the Sunday New York Times, and I think that date was February 4th. Oh, there it is up there. And the article, I just kind of hit some of the highlights here, but it said that the SPY's gain from inception January 1993 to January 2018 was a 541 cumulative return. Daytime frame gains, they said, were minus 4.4, and the nighttime gains were plus 571. Well, I looked at that. I was reading that. I go to a coffee shop every Sunday and get breakfast, eat it very slowly, and get the New York Times out and kind of go through it. And I saw that, and I said, I'd never even thought of it in those terms. But it's a well-respected group that did the research, but it can be terribly misleading. The article lacks the context of when those gains were made other than overnight. And I guess not other than overnight, but what I want to touch on is a little bit of the context and a little bit, what I look at and what can make an overnight trade interesting, or when I maybe don't want to even go near it. So this is just my observations. There are no scientists behind this, no great studies and everything, but very often, what I've found, very often, when there is overnight follow through, or there is overnight follow through when price closes strong in a direction for the day. Very often, there is directional follow through when the value is directionally higher. So I mean, that's part of the context. If the market closes in the center and it's kind of a lukewarm day, there's not a lot of, it's pretty hard for me to tell what might happen overnight. But I do find it's very often they get, follow through to strong directional close in price or value, and those can be up or down, of course. Now, one of the things that we have measured during a couple of our past intensives, and that's about 65% of the time, there is a counter auction to overnight inventory. And a counter auction just means if overnight inventory is long, then there's a pretty good chance in the morning that we're going to get some liquidation of that overnight inventory. Now, this can be a little hard to interpret sometimes. It might be a straight counter auction where the market overnight inventory is long and the market sells off directly. Or there's another thing that can happen, and you have to be aware of overnight inventory, is let's say the market actually is fairly strong, but overnight inventory was long. Well, the overnight inventory, as there's some adjustment going on or rebalancing, may actually hold the market back until that rebalancing is out of the way, and then you will see the market move up. On the same thing, of course, could happen on the downside. If you come into a morning and you have no idea what the overnight is, and you haven't been able to think about this, you're going to be trading at a disadvantage to a lot of people that do understand the importance. I think what goes on overnight, about 60% of the time, the counter auction, I said, but the other thing, what causes the counter auction, and that is that overnight traders are weaker hands traders. They have more of a tendency to panic, at the first sign of something going wrong, and they really don't hold on to positions very long. However, overnight, and I'll show you a couple examples here in a little while. Overnight, if the market starts moving directionally, there's a tendency for it to move that way for a long period of time, and you'll find them buying. I don't know how many times I've looked at it, and the buying takes place one tick above the low of the previous 30-minute bar if the market's going up, or one tick, below the high if the market's going down. It's just amazing. So that's very mechanical. They're weaker hands traders. Those are the kind of things that they look at. Now, shifting the thought here for a second. Some of the markets that trap traders the most occur when an early auction in the morning is a counter auction relative to overnight. But once that overnight correction is over, the market goes back in the opposite direction. In other words, it goes in the direction of what overnight trade originally was. Now, the trap comes in if you get a correction to overnight inventory, and let's say it's on the downside, you see price moving down, and then all of a sudden, once the inventory is corrected, the market reverses. And if you don't appreciate what is going on, it's very easy for you to get trapped by having followed price, not understand what's going on, and take a pretty good hit in the morning. So it's very important to understand, and of course this doesn't happen. I mean, sometimes you get a counter auction to overnight inventory. Let's say it's a counter auction to the downside, and then the market for that day is also to the downside. So it never lets up. So this isn't one of those things you can bank on, but it certainly is something that you have to be aware of. I find it very difficult myself, and I've done enough intensives and enough training programs that know how difficult it is for people to change their minds. So anyhow, it can be a real huge trap. When morning trades show continuation relative to overnight. So let's say, for example, that overnight inventory was directionally strong, either long or short, and there is no counter auction. So, for example, if overnight inventory is long, the market does not show a correction to overnight inventory, and the market starts up early in the morning, that is usually an indication that the market is quite strong, that it doesn't care about the overnight inventory. There'll be no correction to the overnight inventory. And, and part of the thing is, okay, I introduce you to this concept and you say, oh boy, overnight inventory is long. I'm not going long in here this morning. And all of a sudden the market starts straight up. And you say, well, what did I learn about that? Well, again, it all has to do with how you use information that you have. Nothing is simple. Nothing is as simple as do this, do that, etc. You have to always understand the context. But like I say, if overnight inventory is long, for example, and there is no correction to overnight inventory, that very often is a very good sign for the upside. If overnight inventory is short and the market opens and begins to sell off, that is usually an indication that the market was fairly weak overall. Okay, now there's another situation, and that is gaps. Now understand the way I address gaps. A gap to me only occurs when the market opens above or below the previous day's range. In other words, it opens above or below the higher low of the previous day. Many of you are accustomed to talking about gaps that are measured relative to the settle from the previous night. I don't care about that. What I really want to know, if I'm going to have a gap, I want to know if the market is out of balance relative to the previous day. If a market is out of balance relative to the previous day, more than likely we are going to get some pretty big opportunities on that day. So let's say it's an upward gap. The opportunity may be, because we opened outside of the previous day's range, the opportunity may be that the gap fails, trades back into the previous day's range, starts to get legs to the downside, and then targets the opposite extreme of that day. The other situation is the market opens higher, holds the gap, and there is no give back or none to speak of. Then the market is out of balance relative to the upside, and that's usually also a pretty good day. But a gap by definition means that it's going to, if it's to the upside, it means that overnight inventory is going to be basically long, and the gap is to the downside, it means that overnight inventory is going to be basically short. Could there be an exception that, overnight inventory was long and the market sold out of balance just before the opening? Of course it could, but not very often. We have special rules for the Friday the monthly employment release. We apply different rules for that just because it's usually such a hyped, unusual day. But gaps are a different thing. So if the market gaps higher, and the market continues higher, it means overnight inventory was long, the market gapped higher, market's out of balance to the upside. That is usually a very strong indication. The market gaps higher, which would mean that overnight inventory would be long, and then the market comes back and fills that gap. So that means you're getting some selling relative to overnight inventory, and you're just getting some selling because prices were higher. Now you have to look very closely. If you gap higher, fills the gap, comes down and starts trading into the previous day's range, now you've got to look and see, okay, does it get into the value area? Value area is where 70% of most trade takes place. Then it could be an indication that the market's fairly weak. So again, a gap is a different situation. Now we have something else, and that's high confidence from the opening in the same direction as overnight inventory. Generally, I recommend to people not to trade the opening and not to trade for maybe the first hour, maybe the first few minutes. It's not that clear, and I'll try and give some clarity to it. But if the market is pretty high confidence around the opening, and it's with the direction as overnight inventory, that can be an indication of a very strong market. Now, if there's high confidence around the opening and it's the opposite direction of overnight inventory, that's what I covered earlier. Those can be very deceptive days, and they can trap you. You're following price, you think the market's weak, and all you were looking at was a correction to overnight inventory. That's where the trap comes in. But if there's high confidence around the opening, it's in the same direction as overnight inventory, then you've normally got a high confidence market, and very often it leads to a trend day or a day that moves directionally for most of the session. We've covered a lot of information so far. I mean, once you start looking at it and doing it, it's not that difficult. When you're first hearing it, you're probably going, what did he say again? So these are all recorded. The slides are there for you to look at, so you can go back and look and review some of this information. Okay, let me talk about something a little different. Short-term trading, the overnight market. Now, why I put this in is that the market, or the overnight market, is generally in a couple of sections. You have the market from a close leading up to the Asian close. Then you have another market when Europe opens, and that continues until we come to the third market, is when we open in the US. It is amazing sometimes. You will think it's not the same market. The differences between when we close in Asia and when we open in Europe can astound you sometimes. I can't be looking at the same market. Other times they're all moving in the same direction. I said earlier that it is generally the weaker hands traders that trade overnight. That means if you look at the volume, unless there's something major going on, you'll see that the volume will be probably a quarter, all night volume, probably a quarter of what it is in the US during the day time frame session. Now, if in fact there is something major going on in the world, well, then traders will come out of the woodwork, big, small, they'll be there to take advantage of it. If there's nothing really going on, then it's usually smaller, weaker hands traders, and they're the ones that tend to get the market too long or too short. If you look at the market that I've got right in, whoops. If you look at the market that's right in front of me, you will see that at one point in time, the market started, there's E period, and it started to move higher, gradually following trek up. There's half back. It wasn't half back at that time because things changed. Then it continues on up, and these are, I was trying to make it bigger. These are some of the things. Notice how tight together these three periods are. Notice how tight they are on the high. 4 periods within the same tick or within a tick of itself. That is very mechanical trading. And when you see that, it is generally really weak hands trading. Now, the market sells off. Now, the sell-off is, I can't remember if that's S period we're looking at. It's either just before Europe opens or right when Europe opens. So you get a sell-off around that time, and then you see the next period, and then the market, rotates back up. When it rotates back up, notice that the T period I'm looking at right here, again, 2 ticks from here, but notice when it goes through where these highs are, these multiple highs, look at what happens in U period. You get a spike up, quite a sharp spike up, because the stops had accumulated here. Considerable stops had accumulated there. So, this is kind of to be expected. And then, of course, it goes up. And once the stops are taken care of, there is no follow through. The market then trades back, but I want you to this. So when we trade in V period, okay, we have a half back level. Notice the market trades mechanically to half back, and it starts right back up again, all the way back, half back. And I'm going to show you some day trades. I'll go back before we get done, and I'll show you the same thing on a day trade yesterday. And these very mechanical type of trades. So it rallies all the way back up, but notice how sharp the break is. When it got back, it stopped one more time at half back and bounced. Then it took it out, and it took it out with a vengeance. So there's a couple of things here. If you are, awake, or you're in another country, different hours than the U.S., sometimes these markets are pretty tradable, and they're pretty readable. Half back, exact highs, one time framing are all kind of little things and clues that go on in that market. I happen to think they're very tradable markets. I think that a lot of people, they're probably more tradable than some of the daytime frame markets, because you usually get less volatility. You've got a little more time to think about it. But it's just to point out. And now, if you look right here, notice that says settle. So that was the daily settle. The market then sold off. Look how far the market sold off in the first, right after the settle, all the way down to here. My guess is there was some earnings release after there. So the market sells off, rallies, sells off again, rallies, sells off again. So if this is the settle price, I should have mentioned this earlier. We measure, is overnight inventory long or short, by comparing it against the settle from the previous day. So if this is today's settle, and all this takes place at night, when we come in the morning, we say that the overnight inventory is short. And remember, if overnight inventory is short, there is a strong tendency to see a counter auction relative to overnight inventory. So the market, didn't go straight up in the morning. It went down earlier, but then it did rally. And a lot of that really catches the overnight inventory and squeezes it quite a bit. There was volatility in here. There's 8-period high. The market went down an 8-period, but it eventually came back. And when it came back up in B and C and D period, a lot of that is catching the overnight inventory short. So they sold it off, they got it short, and then they got that inventory short, and they had the shorts inventory from overnight. And then you get some incredible rallies from that. Now, this is a simple example. It's not the be all and end all. It is just all I can hope to do on a session like this is get you thinking differently than you may have thought in the past. Obviously, in order to use this information, you have to be able to think deeper than price. You have to understand the inventory, you have to understand the context, and then you have, we always talk about an edge in trading. Once you understand the context, it can give you a much better edge than you had before. Now, when you first learn it, it'll probably mess you up. It's like changing your golf swing. When you first learn it, your game may suffer for a while, but you change that grip in order to move forward as time goes on. Different mindsets. Scalpers versus, slightly longer traders. I'm going to look at half back Monday afternoon. This is not night trading. This is during the day. Remember, we talked about half back overnight, and here's half back during the day. Very visual. It fits the mindset of the day time frame scalper. It's a weak reference for the slightly longer time frame trader, but it can use by both. So this was yesterday afternoon. The market, you'll see M and N period low, and the market rallied substantially. So it's coming off of a very mechanical reference. Now, who trades coming off of a very mechanical reference? That is usually the daytime frame trader or the scalper. Now, one of the messages I'm trying to say here is if you are a scalper, then that is a wonderful reference for you. Scalpers are looking for, visual type of references, and they're the daily high low, the halfway back, and if you're a scalper and you're going to buy that half back, that's fine, but your personality has to be one that if it doesn't work, you got to turn it around very quickly. So the scalper may use that to their benefit. Now, like I say, I'm doing more scalping trades than I've done for a while. However, yesterday, I looked at this and I said, okay, I think that's a weak reference. And if anybody questions this, the intensive doesn't start until February 26th. However, once somebody has signed up, they start getting the evening report and the morning report. And then I add chat comments throughout the day. They're one-way chat that I can put on in front of your machine. You can have it go to your Twitter account, which will alert you. It won't cover the full message on the Twitter because it's not big enough, but at least you'll get an alert. So yesterday, and this is all in writing, so it's not it's not one of these things where we cherry picked. But so we got half back twice yesterday. When I wrote the report last night, I said I went home long a couple of puts. What I'm saying, I didn't take any big position going home, overnight, but I thought that because these references were so weak, I thought there was a good chance that overnight we would break down and get some downside range extension because I thought those markets were weak. And so now we're talking about another way that you can use the overnight trade. As it turned out, that was correct. The market did break, and it broke fairly hard. And I can't see quite what that period is. I had my alarm set on a machine, and it woke me up. I want to say it was about 2:30 in the morning. I'm in the mountain time, I guess. At least at this time of the year I am. So at about 2:30 my time, the alarm went off. I came out and I covered. I guess I had 3 or 4 puts. I covered 2 of them. The last put, the best price I had, I just remember that was 9 1/4, and my sell down here was 18 even. So we look and say, wait a minute, that's worth it. That's worth it to me. But again, so I looked at the day time frame. I saw some things in the day time frame that made me very skeptical, and then I used that and I said, okay, I'm willing to trade overnight, and if I need to take that off. And so that's what happened. So I used the overnight trade in that manner. But notice also, C period, the market comes down in overnight trade. The market comes down and bounces again from exactly overnight. And then it broke, and it broke when it finally broke pretty hard. So you're saying that there's many different ways you can make use of the overnight market. I think even if you don't want to do any trades overnight, you should, with step 1, you should be well aware of the overnight trade. You should ask yourself, does it have the potential to affect what's going to happen on the following morning? And that can be very meaningful to you. Now, I'm going to take this a step further. There's something else I used yesterday, and those that were on the I actually put out a Twitter comment late yesterday afternoon that you all could have read. And I think the Twitter, I may have the wording not quite right, but I think the Twitter comment said something about the conditions were right for either a late break yesterday or a break the following morning. And that was based on not only being half back. Now, let me say, notice the market was way up here at one time. When I put that comment out, it was up near the highs. The market did break in the afternoon, and it went all the way back down to half back. So if there's a scalp trade, you probably got an order in to take it back at half back. But we were up near the highs when I put that out, and you can go back and look at the Twitter comments. And I was looking at the mechanical nature of the market going to half back. But additionally, and let's see if I can get over to it. Oh no, there it is right there. I was looking at New York Stock Exchange volume. Now this won't show yesterday. But one of the things I was looking at as prices were going, this is on our website, as prices were going higher and higher, volume kept drying up. And incidentally, it did the same thing today. So, I went home in a similar position today. Not pretty mild position, a little bit of hedge on it. And the reason for that being, and you may have seen my tweet this morning, is what sent this market down originally was a fear that inflation was back, interest rates would go higher, etc. So we had, a break of 10% or so, and it happened around the world. And then we had 1,000-point rally roughly from the low to the high on Friday. And then at one time yesterday, we were up about 500. So we got, a rebalance from all the short from last week. Now we've got CPI coming out tomorrow morning. So that will be the market's first look at inflationary information. So again, one of the things I tell people, I want to know when that number is coming. I absolutely suggest that you do not look at the number itself. Looking at the number itself, you probably can't resist, but looking at the number yourself has a wonderful possibility to give you cognitive dissonance. Because I'm not smart. I've been around this business for 40 years. I'm not smart enough to know what that number is, what effect it's going to have in the market. I don't know what the big money was really thinking, or if there was a whisper number out there or anything else. And I don't, but the corrections, there may have been corrections to the last CPI that may offset a bad number tomorrow. I don't know any of that. What I do, I look at the market and I want to see what impact what the market does relative to that number. I absolutely do not want to know what the market is. Same thing with crude oil. I do not want to know what the number. I only want to know when those reports are coming. And the largest audience I had for years was working with traders on the New York Merc, particularly in the oil pit, when that market was going electronic. And I mentioned this, a couple of really big traders come up and said, Jim, you're absolutely right. And a couple that didn't said after observing that, they realized that it was absolutely right. It's very important. So anyhow, I'm looking at the references, meaning half back, was very mechanical yesterday. But then, and this is today, not yesterday, but then we saw as markets went higher and higher yesterday, we saw that volume kept going lower. And that has the potential for a pretty good break in the market. So let's go take a look again. I know this is awful small, but here's the market going higher and higher all day yesterday. And while the market's going higher and higher, what's happening? Volume is drying up. And that big move yesterday afternoon for a scalper. And you had another leg to the downside last night. So there's a lot of information out in the market. The question is, do you know how to use that information? And do you understand the importance of understanding things contextually? Too many times, traders that are struggling because they are addicted to price, and they're following price too closely. And boy, it's hard to get away from that. I admit it's hard to get away from that. Take a look at today's. Today's market, it kept breaking and going higher, breaking and going higher, breaking and going higher. Sometimes it's very hard to get away. Okay, you can't do much in the length of these programs, but all I wanted to do is I wanted to whet your appetite. I wanted to respond to the New York New York Times article on Sunday, and I'm sure it's factual, but I'll tell you, it is very hard to use that information unless you really do understand some circumstances that take it up or down overnight, and understand when overnight may be giving it back. One of the things that they did in their measurement, they closed their position on the opening the following day. So they never, when they were using that information, they never had to suffer through the inventory correction or the counter auction relative to overnight inventory. So I think a key thing in that study was that they closed the position out on the morning the next day. So that means that they weren't, and I don't know what size they were doing. I'm going to guess it was fairly small size, because you do it in large size, lots of luck. The market may be very thin, and you may be surprised what you get. So, but I did want to respond to that article. It can be very misleading. And like anything else, you need to understand the context. What I'd like to kind of do a small commercial here is, we've got an intensive starting on the 26th of February. There's a special pricing running through Valentine's Day. And I think If you're interested and you really want to take your trading one step forward, it's a great time to do it. This intensive will also differ from ones, there's many differences from those in the past. But one of the differences will be that we are going to address scalping much more seriously this time. And the reason for that is the volatility has changed. And with the change in volatility, there are some pretty interesting scalping opportunities. Sometimes they're not there very long, but you know they are important, and they do give you some opportunities. I'm going to ask Jennifer, my partner, if she will take a second and show you the dashboard so you can get an idea of how to get to our site and how to use our site. Jen, are you there?
Yes, hi.
Okay.
1 second here. You can see my screen, and I'm going to show you this right here. Okay, so hi everybody. This is the dashboard that if you make a purchase from us for Mind Over Markets, Course 1 or Course 2 or the bundle, you will have access to this dashboard. And basically, this is where we post all of the daily reports. This is where you have access to them. And the archive for the old reports as well. And Jim's live commentary is here. So whenever he makes a comment, you will see it here in its entirety. And also you have access to it from a private Twitter account. However, the limitation for that is up to 280 characters. And then, of course, recorded webinars when we have them will be posted here. Daily synopsis video here. And any other handouts, resources will be put over here. So
let me address the daily synopsis.
Mm-hmm.
Jen has volunteered on her own idea to do a 15 or 20-minute video each day that, you know, it's kind of a time-lapse thing, but it recaps the important salient points for that day in the market. So if you weren't around or you're not trading full-time, you will have a tool to go back and look at the market, review the day, and get a better idea of what happened. You take that and you match that with the reports we put out, you get a pretty clear understanding of what took place. Jen, unless you've got any more commercial to do, let's take the rest of the time and let's start addressing some questions.
Sure. Just real quick, I want everybody to know that our Valentine's Day special is ending tomorrow. And here are the codes. If you guys have any questions at all, please contact me. You can email me at Jim Dalton Trading, or you can call me, at this phone number right here, and I will go straight to the questions. And plus, anybody that has any questions, please type them over in the questions box. 1 second. Let me maneuver over here. Okay. Okay, Jim, do you want me to give you back the screen so that you have it?
Please.
If you need to show charts or something. 1 second. There you go.
Thank you.
Okay. Is Jim back to trading options? There was a time last week that volatility was so high you could be correct on the direction and still lose money. Is there a VIX or ATR value above which you should avoid options? Average trading range for the ATR. That's what he means.
It's a great question, and there were some days when the it was reaching 50% that I didn't touch the options. Now it's dropped back down in the 25, 26 level, and I've been able to make the adjustment. It's hard because mentally before. The options were cheap.
Jim,
and of course,
sorry to interrupt you, but your presentation's not showing and just your desktop is showing. I didn't know if you meant to do that or not.
No, I didn't. Okay, the options, when the price was low for a long period of time, what that means is the chances of the options being in the money are lower. And their options really aren't the price is attractive. The opportunities aren't nearly as attractive when the volatility is low. When the volatility is high, the opportunities are actually better. And I have been using options. And what is even amazing, yeah, I'm going, I used to be about one handle out of the money. Now I'm going a few handles out of the money. For example, last night, when I said I took some puts home, they were the tens. They were the 26 tens, which sounds crazy. That I bought for I think the best price was, I want to say, 9.25, if I remember right, and I got 18 out of those when they broke overnight. So it's amazing. I was surprised. I adjusted to the volatility pretty quickly. Now, obviously, on the days when volatility was in the 50s, I just didn't have the stomach for that. And I just kind of step aside on some of those markets, with the exception of last Friday, when the market did its return last Friday. And I don't know, we offered over the weekend, we offered last week, the weekend report that came out Monday, we offered that report for anybody that wanted to see it. And what I talked about is, you could see, at least I thought I could see on the way down, that market was really getting trapped. One of the chat comments I put out is, this does not look like institutional selling. And when I say it doesn't look like institutional selling, that means, it's more than likely very short-term, not daytime frame traders, but short-term traders. And there's a lot of momentum short-term money out there in big pools. And the market was too thin. What I wrote up, it wasn't what institutions do. And then that market made an almost 1,000-point recovery from the low to the high. Now, I'm only going to give you the best case, but there were options because it was an expiration Friday. My best, luckiest case was a 50-cent option that reached $17. It was crazy. I didn't get all of that $17, but it was a crazy day, and options came in very handy, because I don't think I would have had the stomach in that volatility to own the securities. But no, I am back to using options, and I'm amazed. I haven't had any temper tantrums on the fills. I always recommended that you never want to go a market order on options. I have been surprised, because I've gone market order on most of my orders simply because things are happening too quickly, and I haven't had any temper tantrums over the fills. Anyhow, additional questions?
Yes. Do you pay up on the bid-ask spread when you trade the overnight, or do you use futures?
No, I use options. I use options. I don't generally buy options in the overnight market. I generally will have the options on prior to the overnight. If I do buy options overnight, I will generally use a limit. When I closed out the options early this morning, I saw the market going down, and I just tried to lead them. I put the order in at 18, and I saw the market go, and the market did come to me. It went a little bit lower. You could have got a little more for them, but I just sat there. Well, I'm not going to be greedy. That's cost me too much in the past. So I did put the order in and wait the market to come to me. But I was looking at the market. It looked like there was a decent chance we could get there. Okay, other questions?
Can Jim comment on trading tactics with respect to getting orders filled, stops, and risks?
I'm not sure I totally understand the question. I always, well, let me just talk about something. I'm going to write this up tonight. I'm going to mark the early high this morning. The market went up to the early high, sold off, then D period rallied up there just a few ticks short of that, sold off. Now, when I see that happening, I'm saying, okay, who sells 3 ticks or 4 ticks below the previous day's high? Is that smart long-term money, or is that more than likely short-term trading money? And more than likely, it's short-term trading money. Who's the most fickle kind of trader out there? The short-term trader. Now, in F period, the market goes up to within a single tick of the C period high. That is what we define as a poor high. It is a poor high because there is no excess. Again, who trades at 1 tick off of a high in the morning? An institution would never do that. They've been around too long. Their size is too large to try and pick a spot like that. I ran an institutional desk. I mean, it's not just conjecture. I've been there. So when I look, I say, okay, short-term traders sold it off in D period. They sold it off in E period. Oh boy, look how much they got. And then we come back in H period. Now, what do you think the stop level is up here? Been up early in the morning, close in D, close in F, then sells off. You can rest assured there are a tremendous amount of stops here. Now, on an inside balancing day, those stops, when those stops get hit, what I think happened today, those stops got hit, and those stops then triggered the momentum traders that have been so prominent here for some years. They jumped in and said, oh boy, this is a momentum buy, and away that market went. So again, if you had your stop right, if you had this poor high, for example, and you had a stop in, you're crazy. When the market breaks, you should have taken that trade off under your own power. One of the things I say is, if you're getting taken out of a position by a stop more than about 5% of the time, you need to really rethink what you're doing. You need to come out of a trade by your own power, learning how to monitor for continuation and understanding the context. You look at the context here and you say, wow, this thing goes down in F period. I don't want to hang around anymore because I don't want it back up here. So I get a little break in here and I'm saying, this isn't any good. Anybody that's been around me forever knows that I will always write, this was a poor high, no excess. And it means, does it mean we have to go through there? No, but the odds are so great that the market will go back and get that stop. So if you got to stop there and you wait for it, shame on you. You want to come out under your own power, your own observations. A lot of times people have been taught, put your stop in, have a price objective, and then wait. I never had a price objective. Put the market in, and then you monitor for continuation. If I have a price objective, it's probably a wish price, and when I have a wish price, that's usually a problem. That means I'm not focusing on seeing what the market's doing and what it's giving me. If you start to trade that way, I think you will find that a lot of the execution problems will go away, and I think you'll find that the stops problems will get a whole lot better. They'll be less of a problem. But again, I come back, you shouldn't be taken out of your trades by a stop more than about 5% of the time. If you do, you're not monitoring for continuation and by your own mind reading what the market is doing. Other questions?
Hi, Jim. In Mind Over Markets, you say that only a beginner will wait for the first hour to start trading initial balance. Do you still agree with this?
No. I've come a long way. Remember that how many years ago? It was 20 some years ago that book was written, maybe even more than that. And I've made a lot of changes. I don't use initial balance anymore. That doesn't mean I'm not aware of the concept. I'm looking where there's kind of a natural balance set up. For example, today there was kind of a natural balance set up, basically from the B period low up to here. So that was a kind of a natural balance set up, and it's a relatively narrow balance It wouldn't, for the last couple of years, it wouldn't have been relatively narrow, but it was relatively narrow for the rotation and the ranges that we've been seeing. So again, it's all relative. Now, if a market opens, say, in about the center of yesterday's trading range, we open tomorrow and we open about the center of today's range, I'm not going to be anxious to trade. That's going to be a lot of chop, and where you lose a lot of money. Now, the other day, and I don't remember the exact example, but shortly following the opening, the market rallied, and I think it rallied up to a reference I was using, or maybe the overnight high or something like that, and failed. Now, the trade was only a few seconds, a few minutes after the opening. So I didn't consider it trading in the first hour or trading right on the opening. It was just when the trade developed, I thought it was a good opportunity. Let me talk about something else where we got the screens up here. You saw early on use the word chunking. I don't know how many people, if you've been around me, you probably know the word, but chunking is no more than a psychological term in order to how do you take in and how do you use information. We couldn't live without chunking. For example, first time I back a car out of the garage, I am starting the chunking information to how do I back the car out of the garage. The first time I put the key in, I look, it takes me forever to back out. I'm so cautious. 3 months later, I've cut that time down, by probably 95% to back the car out of the garage, because I've chunked that information and I can operate in a much more efficient manner. That doesn't mean it's always right, but you've chunked the information. Now, what I want to show you is yesterday. Let's see if I can get back to let me see if I can split yesterday out and recall what I'm talking about on the chunking. No, I'm sorry. I don't immediately. Oh, yes, I do know. Hold on. I do remember. I got to put the overnight trade in. Hold just a second. What you're going to see when the overnight trade comes in. This is one part of chunking. And I put out a chat message today and yesterday, and I said, what should you see right now? And one of the chats I put out today, I said, you should see a poor high. You should see a market that stopped at half back. I don't remember all it was. You should see where today's value area is relative to yesterday. Shortly after that, we came out and took out this high. I didn't know we were going to do that, but that was what you should see. Part of chunking yesterday, look at the A period high. The A period high stops 3 ticks short of the overnight high, and then A period sells off considerably. And once that market left this questionable high up here, I saw it, I chunked it. What was in my mind was, if there's an opportunity for the market to start to rally, I thought there was a pretty good chance that we could come back up and take out that earlier high, simply because this was such a questionable high. It was a chunked high. Who sells 3 ticks shy of the overnight high? That is not your strongest money. That's your trading money. Now, does it have to do that? Does it do it every time? No. But one of the things we're trying to do in these tendencies is to teach people to learn how to do this, to be able to look at a market and start to understand what's going on. Just as the same way you're going to look at your kid, if you got a 16 or 17-year-old kid and they come home a little after midnight, you're looking pretty closely. You're trying to take in a lot of information very quickly to have some idea, anything go on? Are they okay? But I mean, you're looking at that. So um, I don't know. I got off the original question, but take me back to the original question. Sorry, Jen, you there?
Yep, yep.
Oh,
Okay, hold on one second. Oh, the initial question you mean about mind over markets? You say that only a beginner will wait for the first hour to start.
oh, yes, 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 yeah. Okay, thank you. Sorry.
You still
No,
agree?
like I say, you're looking for opportunity. I mean, I am careful to this day. Unless there's a real clear um, information around the opening, I don't trade. I mean, what would be clear information? Say there's clear confidence, directional confidence right off the opening. It goes, going in the direction I thought it would. It's right at a reference and it fails. So there may be reasons, but generally speaking, I'm very cautious and not too anxious to trade around the opening. The question I will say, or the statement I will make here, and I've made this many times, and most people do not understand what I am saying. You have to really get experience to understand what I'm saying. And that is, do not go looking for a trade. If you go looking for a trade, you more than likely will find that trade, and it will probably be the wrong trade. You have to let the trade come to you. Now, talking about yesterday, I took in information early. I could have shorted, I didn't because of the volatility, but I could have shorted early. Came to me, I didn't process the information fast enough, and the market broke. But now I had that information, and I watched, and the trade did come to me before the day was over. But when you get experience, what happens if you know what to look for and you can just relax? The trade will come to you. I understand that's a hard concept, and a lot of people don't think that makes any sense, and they are diligently looking for a trade as soon as the market opens. You have to get to the point where you relax and you let the trade come to you. More than likely, those trades that you diligently go out there and find, the success ratio of those trades is usually pretty low. Now, that's a tough concept, but that is a concept we're constantly working on. Okay, additional questions.
Okay, so one question that I just wanted to address is Jim going to tell his trades before putting them to the subscribers? And I think it's safe to say that Jim, this is Mind Over Markets intensive series is not about being a calling trades or anything like that. But if Jim sees opportunities, or in terms of identifying fast or slow trades or possibly scalping opportunities, he would try to point those out. Um, the next question kind of ties into this.
Let me tie that. It's more likely if you just look at the tweet I put out late yesterday afternoon. I said some of the conditions that market conditions that the odds of a break late yesterday afternoon or early the following day were high. Okay, now what did I do when I said that information? I went out and bought puts. But I don't necessarily buy my puts all at one price. I don't necessarily sell them all at one price. So it's not as simple. Where'd you get in and where did you get out? But I'm not trying to teach you where to get in and out. I'm not trying to get you to follow what I do. That is, I think that is not productive. You have to learn um, to make these decisions and see it for yourself. Otherwise, once I'm gone, you have nothing. But we're working very hard to, as Jennifer said, I have in the past identified areas. This would be an area for a fast trade. This is not an area for a fast trade, just like half back and things of that nature. So no, I'm not in the business of calling trades. That's not what I do. I'm trying to help you understand the market so you can make intelligent decisions on your own. Additional questions.
Yeah, this question kind of ties in as a continuation to that. Could Jim share a recent scalp example or two? I think you kind of covered that in what you were saying with your Twitter comment, but
Yeah, and there was today. um, when this, I mean exactly, but when the market came down this morning and we had, this poor high up here, and the information. Oh, wait a minute. Let me get the overnight out. It gets too confusing for me. Okay, when the market comes down today, and you've got a poor high as we had in the early part of the day. Okay, when I see a break, remember it went to C, D, F. When this market gets down in here, to me that's a scalp. That's a potential for a good scalp trade, and you know, it worked out. It was a little bigger than you might expect. Scalping isn't, historically, uh, when I was on the floor of either the Board of Trade or Chicago Board of Trade, scalping may be you're looking for pennies. You want to buy in the bid and sell on the offer. If you could do that all day, you made a lot of money. Well, that's gone by the wayside. The algorithms, uh, make it too difficult. And as an off-floor trader, you're not going to sell. You're not going to buy in the bid and sell on the offer. And and trying to do scalps for a point or two, I think is pretty disastrous. The days you make them, you feel great, but I think more often than not, you're going to be a net loser. Volatility is too great. I'm talking about scalps. I'm talking about a scalp where you get, maybe 4, 5, 6 handles. Uh, and then what I'm trying to do is occasionally I'll do these today now, this volatility, but a lot of times I'm looking for something a little bit longer, like I showed you yesterday on the puts. Now, it wasn't a long time. It took them off overnight, but that's the difference. A scalper yesterday afternoon. Let's go back here. A scalper. Um, let's go spread yesterday out. Uh, in the afternoon, when this market came down to half back. Okay, that is a perfect scalp trade. It's exact. It's very visual. This is what scalpers do. And the question is, that's a great scalp trade, but the person that does that trade has to understand their own personality. And their personality, which I've said many times, if you do this scalp trade, you have to be willing, if it doesn't work and doesn't work very quickly, that you are exiting stage left immediately. If you're a ponderer, it goes through and you say, well, let me think about it. Let me look at it for a while. You should not be considering a scalp trade at all. There's a personality associated with a successful scalper. They can make a decision, they make it quickly, and they don't sit there and overthink the situation. They have a pretty good idea what's coming up. They're looking for the trade to come to them. They recognize the opportunity pretty quickly when it gets there. So it's a total different personality in there. And you got to understand who you are. A lot of people come in and they think they're going to trade for 1 or 2 handles, and I don't think that's going to work very well. Okay, let's take two more questions. We're getting pretty late in the day.
Oh, we have quite a few, but this is one that I really wanted to address. What about real-time market assessment? It is always easy to look at the market after the fact, but have one of these webinars during the market open and talk about what is happening at that moment and things to look for, etc. That would be much more effective. And Chris asked this question. Chris, you're absolutely right, and that's why for our courses, for our intensives, we do a morning webinar every day. And then we have additional webinars, sometimes in the afternoon or at different times, but we have over 60 hours of webinars planned for session 1 alone. So we spend a lot of time trying to prepare you before and during the market. I don't know if there's anything else you want to add to that, Jim?
A lot of time in the morning. We come on a half an hour before the opening, and we stay for an hour and a half after the opening in order to look at situations. and give you some orientation for the day. Don't we have one of our webinars coming up here shortly that's during market hours?
Yes, I think you're talking about the one on the 15th. I think that one's at noon Eastern, if I'm not mistaken. Yes, we do have a webinar on February 15th, review of morning trade and scenarios for afternoon trade, and that's at 12 noon Eastern.
So that's taking place during live markets. So we have thrown one in there.
Mm-hmm.
But like I say, the whole intensive, like we do them hour and a half live markets in the morning, and then the live. What helps is the live chat where I can go out, and I can type in, or actually I have a Dragon, which is I can talk into the mic, and I can put the chat comment on the computer very quickly, and I hit publish, and it hits your desk, and it hits your computer. You get a bing on your Twitter that it came through if you have Twitter. And again, that's all to keep you as much in touch with the current market as possible. All right, two more questions, please.
Okay. Without a stop, how do you manage risk? What do you use to calculate how much you are willing to lose on a trade?
Oh, okay. I use a stop. No, I don't use stops on options, but no, I would never suggest not using a stop. My statement is yes, you need to stop, but you need to come out of the trade on your own volition. You watch and monitor the trade for continuation. For example, today, what is monitoring for continuation? If you were short, it's the C, D, or E or F period high. When this market gets down here, it breaks, you're not going to wait till it gets all the way down here, probably, but you're not expecting a lot. And you don't hang around till it comes back up and takes out H period. You look at this information, how poor the high was, you got a pretty good, can I give you exact odds? No, but I can tell you the odds are pretty good. We're coming back through that. And of course, we did. So your expectations to the downside shouldn't be very high. Your question is, how do you set a target for how much you want out of a trade or going to get? You don't. You never know that. That's why I say you monitor for continuation. Remember, it's a continuous two-way auction process. What the profile does is record those continuous two-way auction process in graphic form. So we had in the morning, we had an auction to the upside. We had an auction to the downside. We had an auction to the upside, to the downside. The profile is collecting those. It's a scientific way in order to organize the data. You then use that data, to kind of make an assessment of what's going on. Is it easy? No. Are there exact percentages and odds to it? No. But it's like I say so many times, when I drive on ice, I may not know the exact odds because I don't know, is it really sticky ice? Is it cold ice? Do I have good tires? Do I have bad tires? How fast am I going? Blah, blah, blah. But I do know that I got more risk driving on ice than I do on hard pavement. I can't get there exactly, but there's some things, you get to the point where you just know. And that's part of what trading is. It's not going to be by the numbers. It's going to be you getting involved and being in touch with the market. Jennifer, final question.
Okay. Today, our second distribution seemed to find acceptance above the overnight high. Was it wrong to look at JLM period as mechanical and plan for a big end of day pullback similar to yesterday? Or was that just the market finding acceptance above the overnight high?
No, I think the market was, I didn't know it was really the overnight high, but I think it was just, this market, this is a lot of single prints to break out of here to the upside. More than likely some short covering. People got too long yesterday, probably got too short last night. And then, you got the short covering. And, I thought it might break harder than that, simply because the volume was drying up so much. And so I knew the risk was there. But I also knew that with a big number coming out tomorrow, those that were short were probably squaring up their positions before the number. And there might be some larger traders that also want to square the positions ahead of the number in the morning. But no, I thought it might have watched a comeback a little more, but it didn't. But I do, one of the things we take, and the afternoon pullback low at K period, that is one of the clear references that we will use. It will be on the report tonight, and we'll use going forward. You know, that what you want to see tomorrow and overnight. Does anything change relative to late today? Okay, if we stay above the afternoon pullback low, then nothing has changed relative to late today. We get down below this, and guess what? There is a change relative to today. Trading is about change. All right, let me say thank you, and I sincerely hope that some of you out there will consider joining us for the intensive that starts on the 26th. Remember that the beneficial pricing goes through tomorrow, and there's as Jen said, there's 61 hours of really solid instruction with webinars and stuff on there. It's a no nonsense program, and again, all I can commit to is I'll give you everything I have in order to help you improve your trading. So I do hope you consider it, and I hope you join us and take advantage of the Valentine's Day pricing. Once again, thank you. I'm sorry we can't get to all your questions, but we're over an hour and 20 minutes. Which was supposed to be an hour. Anyhow, let me say thank you. I'm sure Jen says thank you, and we hope to talk to you.
Yes, thank you very much, everybody. We will post the recording of this later, as well as the slides, so that you have those codes and our contact information if you need it. If there's anybody out there that has any questions at all, please don't hesitate to contact me. Email or phone, it's fine. Thank you very much. Bye-bye.